you're having a great weekend out there. We want to thank you so much for joining us, spending part of it right here on Aspire to Retire with Ralph and Tim Short, the father-son team, and the financial advisors behind Welcome Home Financial Partners. You can go to the website, welcomehomefp.com, find out more about Ralph, about Tim, the entire team. Again, welcomehomefp.com. You can also give a call, set up a time to speak with them. Come into one of the 3 offices here in the Richmond area. That number is 804-635-3550. Again, 804-635-3550. My name is Chris Swan. If you go to the website, you'll find out more about, like I said, Ralph Short. He is not with us today on this episode, but I do have the younger of the two, Tim. Glad to be with you once again. How are you, sir?
Yeah. Thanks for having me. And hopefully people aren't changing their radio dials now that they found out that Dad's not here.
No, hopefully not. But I appreciate you taking time out of your schedule to spend with the listeners. Hopefully Ralph is enjoying a little bit of time off. But yeah, let's go ahead and get into it, because here's the thing. People do aspire to retire, I think, but maybe they don't necessarily know how. The first step, well, just by listening, I think you're doing a great job with that. The next step is letting the team at Welcome Home Financial Partners put together your own personalized retirement roadmap. Again, that starts at welcomehomefp.com. So we've now, I want to start actually by talking about TV, because we've made it through 22 seasons of Grey's Anatomy, and ABC intends on keeping it going. The show has been renewed for season 23, and there's even a spinoff in the works. So sometimes doing the same thing over and over keeps working, and sometimes it doesn't. What are some things that you see retirees doing with their money that just aren't as effective as they used to be?
Well, I think this is kind of a funny correlation here, but it's true. And sometimes it works and sometimes it doesn't. Difference being is our life isn't a TV show, and we want to make sure that what we're doing does work, right?
Of course.
So I think it is important, because retirement's changed dramatically over the last, 10, 20, 30 years. And the old days is you worked for a company for quite some time and you got a pension, you had Social Security, everything looked pretty good. You're pretty much taken care of. But now, you've got to be self-reliant. And I think one of the biggest things that people rely on is that old 4% rule. And depending on who you're talking to, it could be the 8% rule, which I know we've talked about that in the past as well. But this is meant to be a guide. And, so many people get so accustomed to not touching their assets while they're working, because these are called retirement plans or retirement accounts for a reason, meaning we need to leave them until that point in time. So I think it is very important. People need to focus in on actual income strategies and not, I'm going to take 4% or 8%, or, my accounts aren't doing well, and now I'm just not even going to touch them, right? It's not the retirement that I want. I don't know about you, Chris, but I'm sure you'd probably say the same thing.
Yeah, I can't imagine. Just like, I'm not going to do anything. I'm going to freeze myself until the markets rebound. It's not possible, and B, I don't think anyone really wants to do that.
Yeah, no, that's not a really good plan. And, talking about not having a really good plan, there's a lot of people that are looking at their home as equity, right? So, yeah, that's great, but that normally doesn't produce any type of monthly income. So what would you rather have? More financial assets, more cash, or investments, or would you rather have more equity? Most people are probably going to tell you that they would probably rather have more financial assets or cash or what have you. So,
sure.
I mean, you've got to make sure that, because one of the biggest questions that we get quite a bit is, should I pay off my mortgage if I still have my mortgage in retirement? Well, I think the biggest issue with that is if you take out a large lump sum and now we're paying that down, well, you've got to realize that even if you got rid of your mortgage, there is still monthly bills when it comes to your home, right? Still going to be property taxes, your real estate taxes, and your home insurance. So it's not, hey, if my mortgage is $2,500, now I've got $2,500 extra per month because I paid off my house. No, you probably have $1,500, maybe $2,000, just depending on where you're living, because the other part's still going to go towards taxes and insurance, and that's not going away, right? Probably not going down either.
No.
So those are things that you've got to really pay attention to. But, like we talked about before, is, people rely on, the market's always going to come back. Well, there's a potential, right? It has. We just don't know how bad the downturn is or how good the rebound will be, but also the length of time. And that's what's often overlooked, is because, hey, everybody remembers 2008, but there were other bad times as well. But in 2008, you could have lost half of your portfolio in a matter of 12 to 16 months. Well, if you're looking to retire in 2009, most people probably didn't retire the way that they wanted to. So once again, those are important things to pay attention to, but not only just waiting on the market to rebound, but you're not adding to those accounts anymore. If you don't have earned income, you can't participate in your 401k, obviously, if you're no longer working, but in your IRAs, if you don't have earned income, and yes, I'm talking about working, right? Then we're not going to be able to make those contributions. So you're now relying solely just on the market to come back. So those are things that people have to pay attention to. But when you're working, we're not tapping into the assets. It's a lot of times people overlook those scenarios.
And in the working world, when we did see our 2008s, even our 2020s and 2022s, because we're continuing to contribute, we're not actually realizing how much the market really fluctuated because there was money still going in. So your balance potentially was going down, but it wasn't going down in correlation. When it comes to retirement, if you're withdrawing, it's also not in correlation because that is, you're compounding those losses. Do you think people, speaking of 2020 and 2022, do you think they've been lulled into yes, the market will go down, but it's going to rebound quickly because the past couple of instances, that's been the exact case?
Oh, yeah. I think everybody gets bit by recent memory, right? When things go really well and things rebound really quick, it's easy to remember those times. But once again, we bring up 2008, and yes, people still remember that, but they probably don't feel it quite as bad.
Right.
Now, if it was 2010 or 2011, they probably feel it a little bit worse, right? So once again, I think that's kind of like the most recent history. And sure, 2020 when COVID hit, whatever was going on in the world, whatever conspiracy you want to believe in or whatever, there's a lot to do with that. But the market came roaring back because of different scenarios. And that's why, every downturn is never going to be the same. Most people hear of corrections, they hear of recessions, and then the D word, which we're not going to say on the show. But I think that's important to really kind of feel out what that looks like, because once again, the way you're going to make money the majority of the time is through the stock market, right? Compound interest. Hopefully, if there are 20-year-olds out there listening, compound interest is your friend. It's everybody's friend. But once again, is the time in the market is the most important because you have time for that compound interest to hit. Nobody knows when the market's going to go down. Nobody knows when the market's going to go up. And in this day and age, there's swings every hour on the hour, it feels like.
More or less, yeah. And here, you can't understate the growth potential in the market, but you also can't understate the risk. And as you get closer and closer to retirement, it's really about minimizing at least a portion of that risk, not necessarily all of it. You're going to need money down the line. And so letting that grow like a younger investor is possible. But for the immediacy, you want to make sure that you're not compounding those losses. And that's where that retirement roadmap really comes into play, because that's one of the pillars. You're going to have income coming in and ideally not selling in a down market. We all know the saying, buy low, sell high. People tend to do the opposite when the markets see their downturn. So having a plan put in place to say, yes, we have accounted for this, because it's not a question of if, it's a question of when and how many times over the course of your retirement. With a proper plan, like a retirement roadmap, you can take these into account and say, okay, yes, we know the market's going to take ups and downs. And then when it is down, this is what we're going to do. When it's up, this is what we're going to do. But it is customized specifically for you. And that begins with a phone call, setting up a time, complimentary time to speak with the team at Welcome Home Financial Partners, 804-635-3550. Let's get 804-635-3550. If the market does in fact feel confusing right now, well, you're not alone. Investment manager Charles Babrinskoy tells CNBC that one emotion seems to be driving a lot of investors.
Yeah, at any given time, there are times in which people are overly greedy or overly fearful. And I think right now it's absolutely the case that we're in overly greedy mode. There is FOMO all over this market. And the indicators that people talk about, whether it's your cab driver asking you about his latest AI wins, or it's one of your kids telling you got to get with it and invest more in technology, all of these things tend to be signs of euphoria, and it's never good to be buying when everybody's buying.
There's that phrase FOMO again. Nobody really wants to feel like they're sitting on the sidelines, but how do you help people in retirement or those approaching retirement benefit from the market without letting that fear of missing out drive their decisions?
Well, in a perfect world, we would know what was going to happen that day.
Oh, that's easy. Yeah, sure.
So in a perfect world, but we know we don't live in a perfect world. We still live in a really good world, but not a perfect world. And I think fear of missing out has probably always been around when it comes to investing. But between social media, 24-hour news cycles, I think a lot of that's been amplified. Everybody, I shouldn't speak in absolutes, but most people, they want to make us all that they can. They don't want to lose anything, and they want to be able to touch it whenever they can, right? Whenever they like. The fact of the matter is, if you're using one investment vehicle, you're not going to get all those things, right? So there's going to be things that you're going to miss out on. Now, once again, you talked about it earlier, is that you're supposed to buy low and you sell high. The issue being is we don't know when the highs and the lows are the highs and the lows.
Right.
So, but to the point is, should you be buying into the market when everybody else is and it's going up? Maybe not, right? But when things are going down, that could be really good potential. So, but once again, it also still works a little bit different compared to where you're going to be for retirement. Once again, 20 years old, 30 years old, 40 years old, everybody's going to look a little bit different. And that's why I think it's important, because you'll hear all of the different catchphrases, right? We talk about AI quite a bit. We talk about cryptocurrency, the latest stock that's up 50% in the last week. Sure, it would be nice to hit every home run every time. Odds are you're not going to be able to do that. But are you willing to swing and strike out every time because you miss every shot you don't take? But on the same side, if you've got a really good retirement plan that you've been working on and it's written and you can revisit this on a frequent basis, that's where the most important thing is, because, you worked all these years to get to a certain point. You've amassed the assets that you've got, right? We've had the accumulation. Mm-hmm. Now it's a little bit different. So if you're seeking that 50% return in a week, well, you could seek the negative 50% return in that week as well. So that's where it's important to really start figuring out, okay, if we need X amount of dollars a month to live on, well, let's make sure that we get that locked up. We know that that's coming, right? Because we have things that we need and we have things that we want, right? Some people have a hard time differentiating the two,
right.
But on the same side is we got to make sure that, hey, it's okay to have a little bit of risk or a little bit of gamble with some of this money, and we can take more risk with some and take less risk with others. So once again, that's what the retirement plan is for, right? The retirement roadmap is we can show you, okay, hey, we do these different vehicles. We have these different strategies. We know we're going to be okay on this side. So maybe we're able to take a little bit more risk. And if you are trying to find that 50% return overnight, maybe you can do that. But is that smart to do with all of your assets? Probably not.
Think of it kind of like I don't know how you feel about gambling, but casino money. What can you afford to lose or play with at the casino without you having to go home and have a really tough conversation with your spouse, or losing a house or anything like that? You mentioned 50%. That is an extreme, I think, but 10%. Let's go with that, because the market has kind of done that for a few years now. Would another 10% increase make or break your retirement portfolio? Probably not. It would be nice, but would a 10% decline, or maybe even 15 or 20, would that? Probably. So it really is about minimizing some of that risk as you get closer and closer to retirement. Not eliminating it entirely, not saying that you can't, have money in the market for future growth, because time is one of those commodities that, becomes more limited. But finding the right balance between risk and preservation all starts with sitting down and speaking with the team, a fiduciary team, might I add, like Ralph and Tim Short, acting in your best interest, not in company X, Y, or Z's best interest, but really what's going to work best for you. They're going to present that information, let you make the decision at the end of the day. That begins with setting up a time to speak with them. You can go to the website, welcomehomefp.com, find out more about them, schedule a time there. You can also give a call right now. This won't be the meeting, just to let you know, but this will be to get on the calendar for the coming weeks. That number is 804-635-3550. When people get speaking roles in TV shows and movies, they usually earn residuals. Some people call it mailbox money because, well, the checks keep showing up. There is a flip side to residuals, however. Ted McGinley, who made a lot from Married with Children, tells Page Six that eventually those checks, they kind of dry up.
I was on a Love Boat for 3.5 seasons. I was on Happy Days for 4 seasons. I've been getting residuals all the time. I have a whole stack upstairs for 1 cent.
Do you bother cashing those in?
No.
What's the cutoff? Like, I would be pretty cheap. I would still $5 I'd put in. But what's your baseline?
I'd say anything above 2 is going in.
$2?
Yeah.
Now, McGinley's, he's actually still doing pretty well because he's on Shrinking on Apple TV. Recommended if you haven't seen it yet. But in the retirement world, we often compare residuals to annuities, the paychecks that come in regularly. But do annuities do more than that? Do they go a step further?
Well, I absolutely agree with you. If you haven't seen the show Shrinking, I would highly encourage you to, because it's hysterical. So, but yeah, I mean, I think there are a lot of similarities there, but there's also differences too. I find it interesting of getting a less than $2 check and we're going to put it on the dresser. But if we get a $2 plus check, we're going to stick it into the bank. So, residual checks, if you're looking at annuities, there's many different types of annuities. If you want guaranteed income, that's a good place to be. We can make sure that we've got that coming into you. But what you don't want to do is lock up yourself and then you start having inflation erode some of your principal, because sometimes some of the guarantees aren't going to keep pace, right? So if we've got those the residual checks coming in, we want to make sure that those are going to continue to grow, and there's ways of structuring that. But once again, if we're seeking guarantees and we know we need X amount of dollars per month right now, that could be a really good place for some of your money. Now, annuities aren't right for everybody. I think we've said this a few times before.
Once or twice, yeah.
it just depends on what you're trying to accomplish, right? So this could be a good benefit to your overall retirement portfolio, or it might not. But if you're looking for, I guess 50% growth is a little bit dramatic, but
It'd be nice,
go back
yeah.
to it. So if you're seeking 50% growth in the market this year, well, annuity is probably not the right spot for you. But you just got to keep in mind that there's so many different ones out there. But if you are one of those people who's more worried about outliving your money or not having the guarantees, or you want the peace of mind, annuity could be a really good option, right? So I think it just makes your retirement more enjoyable when you know that you don't necessarily have to worry about what the stock market is doing. Sure, you can track it, you can watch it, but on the same side is, do we want to every day, drink our morning coffee and get online and track the S&P 500 and whatever else you're into? Probably not, right? That's not what I want to do in my retirement. Sure, got to check it, but it's not a daily occurrence.
No, not at all. And I certainly don't want it to dictate how my day or how my week is going to go. I wake up and I see that the market is down. I go, well, I guess I can't do anything today. I'm just going to go back to bed. Actually, that might not be bad now and then, but say, I cancel dinner plans for this evening. The market's down. You want some stability. You want to be able to go, okay, well, that stinks, but that doesn't affect me right now, or I've got time to rebound. But finding that right blend starts with having something where you know that money is going to be coming in regardless of what the market is doing. Social Security, going to be a component of that. A pension, if you have the luxury of that, is going to do that. An annuity can be a part of that at the end of the day, because you want to make sure your monthly expenditures are coming in regardless. You mentioned, using your home as a source of equity. I don't think you're going to be able to deal with the power company or pay for your groceries and go, here's the doorknob for my house. Yeah, it doesn't really work that way. You want to make sure you've got that money coming in, and annuity can be a valuable part of your retirement strategy to provide that income. But it's not right for everybody out there. Think of it as a tool. It is a financial tool in your toolbox. It may not be the right tool for some people. It certainly doesn't need to be the entirety, but it can be a valuable, well-rounded part. Have a conversation with the team, with Ralph and Tim Short. Again, as fiduciaries, they're not going to recommend anything that they don't believe is going to work in your best interest, but they will bring up the subject and approach that, because that income at the end of the day is paramount in retirement. You're going to need money to pay for things. 804-635-3550 is the phone number. How you set up a time, how you start that conversation with Ralph and Tim Short. You can go to the website as well, welcomehomefp.com. Another component that comes up in retirement that people either intentionally don't think about, or they just aren't aware of it, is taxes. It is very different in retirement. And I saw an article with the headline, I'm 80 and my RMD, required minimum distribution, is $300,000. What the heck am I supposed to do about my huge tax bill? I feel like this is another example of what can happen if you're very successful in the working world with your 401k and your IRAs, and it almost feels like you're getting penalized down the road. Isn't this why we talk about, the possibility of utilizing IRA to Roth conversions?
Oh, yeah. I mean, this is a perfect example of why proactive tax planning can make a huge difference, right? Most people, they don't want to talk about taxes, right? Taxes aren't the sexy thing to discuss. Right. Most people don't like it. They only think about it on April 15th or whatever potentially the deadline would be every year. Mm-hmm. And it's always out of sight, out of mind. Well, what they don't grab a hold of is, hey, there's going to be a point in time when we have to start taking money out of these accounts, whether we want to or we don't, unless you are stubborn and want to pay a penalty, right? So don't know if paying the penalty is the right strategy. I haven't come across one person that said, hey, I'll go ahead and pay a 25% penalty. Doesn't make a whole lot of sense. But sure, we want our money to grow, right? Raise our hands. We all want our money to grow.
Right.
But if it's all pre-tax, you're going to run into some issues. In case in point, right here. Now our RMD is $300,000. Well, that's a pretty big, because you also have to think, is this isn't all of your taxable income, right?
Right.
We might have our pension. We have Social Security. We might be doing other things, right? A lot of people around the area have rental properties. There could be side jobs, there could be side gigs, whatever, right? All this is going to come into play. So yes, Roth conversions, I think, matter quite a bit. Now, the issue being is that no matter what, we will pay our taxes, right?
Correct.
If it hasn't been taxed, we're going to pay taxes at some point. Now, do we want to just defer those taxes, or do we want to be a little bit more proactive with that? I think a lot of people now have gotten to the point, because there are a lot of people now that have seven figures in their accounts. And before, if we were 10, 12, 15 years ago, that wasn't as common as it is now. Well, if we retire, let's just call it 60, and we don't need to tap into that pre-tax bucket, and we just let compound growth do its thing, and maybe in 13 or 15 years, because it just depends on when you were born, what that's going to look like. And now instead of $1 million, now we've got $5 million, because yes, that is a very good potential of happening. That's a huge RMD.
Right.
So why don't we just go ahead and start doing either some conversions or just start taking out the taxable withdrawals, and then we can reinvest, right? So Roth conversions, they've been talked about quite a bit. A lot of people don't quite understand the concept because, once again, for instance, if we are looking to convert $100,000, well, we're going to have to pay our taxes on $100,000, right, for this year. So you've got to be mindful of that. And there's certain ways of doing it. We can talk about that, when people call and they decide to come in for that retirement roadmap. But it is very important, because if we just let it build and build and build, well, that's going to be a huge tax burden later. But also, it could be a huge tax burden for your spouse, for your kids, for your grandkids, or whatever. And yes, I know when we start having these conversations, we get a few different answers. Some people say, well, hell, I don't care. Let my kids pay the taxes. I don't need the money. Yeah, well, you have to think about it too, is that they're probably in the midst of their career.
Right.
They're probably earning some good income as well. And that potentially is going to throw them into another tax bracket or two, right? So, but just talking about the values of the tax deferred accounts, one thing we haven't talked about yet is maybe the potential for increasing tax rates, right?
Yeah.
So once again, if you're in a 20% or 22% tax bracket today, we wait 10 years and now we're RMD age, and now you're in a 30% or 40%. I won't say 50 because I know that's too dramatic. But, if we're up some more, then that's just more taxes we're going to have to pay. So once again, one of the strategies that we look at, maybe not just doing Roth conversions, but okay, hey, let's just say that your portfolio made $100,000 this year. Why don't we go ahead and take out $75,000 or $100,000, maybe reinvest, maybe do some conversions, but let's start going at it more proactive and not just kick the can down the road.
There are hopes, and then there are things that we pretty much know to be true. We, as we said, we hope that the market will grow and our portfolio will grow over time. I think that's everyone's wish out there. We also, I think for the most part, well, I don't know, Tim, are there people out there who think that tax rates are going to go down anytime in the future?
No, I don't think I've, honestly, top of my mind, I couldn't tell you one person that said that.
Okay. Just we're $39 trillion in debt. The Trump tax cuts as there are right now, they are permanent, quote unquote, but we know, what that actually means. If we hope that our portfolios will grow down the line and we think that taxes will go up in the future, I think it's worth entertaining the possibility of paying on a lower balance on a lower tax rate, or at least on a known tax rate right now, so that way down the line, you can let that grow. And no one wants to pay taxes. I get that. I understand. But paying them now and then let that grow tax-free in the future, there's a lot of merit to it. It's not going to be right for everybody out there, but talking about the market, we don't want to sell low. We don't want to realize those losses. If we don't sell and we stay in the market long enough, ideally that'll rebound and it'll go back. You write a check to Uncle Sam, that money's gone. So it is worth taking a look at, entertaining the possibility of utilizing Roth conversions, because taxes going to be a factor one way or another, and that's part of that retirement roadmap. It's probably not the sexiest part by any means, but it is an important part you want to address so that Uncle Sam isn't the biggest beneficiary to your retirement accounts, to your hard work. 804-635-3550 is the phone number to set up a time, complimentary time to speak with Ralph Short, Tim Short, and the team at Welcome Home Financial Partners. You can also go online to the website, welcomehomefp.com. We mentioned market losses. We mentioned taxes. There is another thing that can result in a lower balance in what you've got, and that is fees. Back in the early 90s, the financial industry shifted toward fee-based advice, and that's when the 1% assets under management fee took hold. More than 30 years later, that is actually still the default. So why don't more people know what they're actually paying? Well, here's Morningstar analyst Don Phillips.
Most people don't do the math on it. They don't understand the power of compound interest. They don't understand the cumulative costs that they're paying. And if it's out of sight, out of mind, it doesn't get scrutinized. But the amazing thing is that much of financial services has been able to position this as a real benefit for the investor, is that you don't have to write a check for us, that we do better as you do better, that, our fee is just subtracted from your returns. But they never sit down and say, well, that 1% when I came to this advisor with $10,000, was this dollar amount. Now that I've got $10 million, it's the same fee. And now it's a much bigger charge. And would I realistically look at this and say that's an amount I would pay?
So if fees are out of sight and mind, what is the best way to bring them into focus so that people see the actual cost that they're paying?
Well, I think that's a great question. I actually think that's the wrong place to start. I think the better question is, what are you getting for that fee that you're paying?
Value. Okay.
Right. And I think that's the most important thing and sure, I mean, people are outside out of mind, 1%, 2%, 3%. I've seen people pay upwards of 4%. Now, I will tell you.
Wow.
And unless you're getting a massive return or you're talking every other Friday.
You better be getting that 50. Yeah.
Yeah. I don't quite understand. And trust me, we've seen people pay quite a bit, right? But I think, one thing that often surprises us is people don't know. And I don't think anybody I've ever asked before when they came in to see us for the first time, when I asked the question of, well, do you know what you're paying your current advisor if you got one? They're like, no, I don't, right? Because like I said, it's outside out of mind. If it's just directly deducted out of those accounts, they're not really paying a whole lot of attention. And sure, if you're paying 2, 3, 4%, that can have a massive effect on your portfolio. So, but once again, what are you getting for that? Are you getting strategies? Are you getting frequent reviews? Are you getting, the insight that you're seeking? And if you are, then maybe 1% or 1.5%. I don't think I'd go as far as saying 2% would be okay. But, that is very important. And sure, yeah, we've all heard those commercials, we only do well when you do well, that type of thing. And yeah, do 1% on $1 million versus $10,000, it is a different dollar amount. But if you've got an advisor that's doing the right things for you, has constant communication with you, and they took you from $10,000 to $1 million, I think that's a fair trade-off, right? So that's the thing, is it's always about the value, and it's not about the actual fee is what you're getting for, because it's the old phrase of you get what you pay for, right? So if you're getting really good value, why stop paying for it? Now, if you're paying 4% and you're getting a 10% return, then those are things that we need to talk about. But it's always part of the conversation, right? And it is important to have the conversation and know what you're actually paying.
Because you can't really assess the value in it if you don't know what you're paying. We mentioned another plug for the show Shrinking on Apple TV. That's a subscription base, right? And I know every month how much I'm getting charged for Apple TV. And between Shrinking and Formula One racing and the new Cape Fear show, I'm plugging all these things right now. For me, it is worth it. I enjoy it, and that is fine. If I get a notice that says, hey, the rates are going to go up starting next month, like we do with any other thing, then we assess it. Is it still of value to me? If you don't know what you're paying, you can't assess the value. And that is money that you are paying, maybe unnecessarily, and that is akin to a market loss. That's money coming out of your portfolio. So get a better understanding of what you're paying. Get a better understanding of what taxes are going to look like in the future. Get a better understanding of where the income is going to be coming in from in your retirement. That is what the retirement roadmap does. That is what the team at Welcome Home Financial Partners does for their clients. This helps create this roadmap, not just create, but maintain as you go to, through, and beyond retirement, because just like any other road trip, there's going to be detours along the way. There's going to be things that pull us off track, some good, some bad, but it is all about making sure at the end of the day, you get to where you want to be. That starts with a phone call, 804-635-3550, or you can go online to the website, set up a time there as well. Always available there, welcomehomefp.com. As always, want to thank you for joining us here on Aspire to Retire with Ralph and Tim Short, brought to you by Apple TV. Just kidding, it's not. But want to thank you so much for joining us. Hope you have a great week ahead of you. Stay safe out there. Take care of one another. Tim, always a pleasure. As we wrap up, I want to leave you with a final word.
Thank you, Chris. It's always a pleasure. And I think now it's time to go home and watch some Apple TV. So, there's a lot that we covered today, and I think just because it was two of us and not three of us, but there's a lot of good things that people need to pay attention to. So, if you're within 5 or 10 years of retirement, you're already retired and you're looking to see if you're still on track or maybe on the right track or just want that second opinion, we'll sit down with you and review your investments, analyze, if there's a strategy there and see what your tax situation is, but also talk about those fees and start uncovering some of the details maybe you've often overlooked. So, give us a call, visit the website, sign up for an event coming up. You can also schedule your complimentary retirement roadmap for you, no cost, no obligation, but we'd love to see you guys in the office. And until then, we appreciate everybody listening. Take care.
All content is for information purposes only. It is not intended to provide any tax or legal advice or provide the basis for any financial decision, nor is it intended to be a projection of current or future performance or indication or future results. Opinions expressed herein are solely those of Welcome Home Financial Partners and Welcome Home Wealth Advisors, LLC. The information contained in this material has been derived from sources believed to be reliable, but is not guaranteed as to accuracy and completeness and does not purport to a complete analysis of the materials discussed. All information and ideas ideas should be discussed in detail with your individual advisor prior to the implementation. Each individual investor's situation is different, and any ideas provided may not be appropriate for your particular circumstance. Advisor services are offered by Welcome Home Wealth Advisors, LLC, a registered investment advisor in the state of Virginia. Being registered as an investment advisor does not imply a certain level of skill or training. Insurance products and services are offered through WPI Holding, Virginia Insurance License Number 138509, an affiliated company. The information contained herein should in no way be construed or interpreted as a solicitation to sell or offer to sell advisory services to any residents of any state other than the state of Virginia or where otherwise legally permitted. Welcome Home Wealth Advisors, LLC, and Welcome Home Financial Partners are not affiliated with or endorsed by the Social Security Administration or any government agency.